bubbles are great because if you get them early, you make a lot of money. But the trick is getting out. You don't make money in a casino until you've left the casino.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 13th through January 20th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this returning guest. Clem Chambers is the CEO of Online Blockchain PLC. He's also the founder of an upcoming financial information website, anewfn.com. He's the author of Amazon #1 bestsellers, 101 Ways to Pick Stock Market Winners, and Trading Cryptocurrencies, a Beginner's Guide. He's a prolific financial commentator, written for Forbes longer than just about anyone. And he's here with us today on Liberty and Finance. Today is Monday, January 20th, 2025. Clem, thank you for coming back on Liberty and Finance.
Straight back on.
We wanted to get your renowned for being someone who makes early market calls based on leading indicators of big moves in the market. And we'd like to get your view because of the current market situations in the big picture, because many people have been watching the markets, especially the stock markets, over the past 3 to 6 months looking toppy. We've seen insiders selling rather than buying 6-1. Warren Buffett accumulating the largest cash position that his company has ever accumulated. And it appears to many that there may be a time for a volatility ahead, and we're wondering what you're seeing in your forward view of the big picture.
I had a kind of funny feeling about the American market because it is outrageously strong, and there are some incredible valuations in there. And I should have just bought a load of good American tech stocks 6 years ago and gone on a cruise for the last 6 years, rather than go around trying to, pick other stocks. But nonetheless, when I look at the market and I get a nosebleed at the valuations, what I see, what I feel, what I think is we haven't had a bubble yet. We've had a boom, but not a bubble. And these things don't come to an end with a whimper. They always come to an end with a bang. And they always come to an end when there's a bubble and everybody's singing Hosanna and it's going to go to the moon. It's going to be NASDAQ 10,000 million billion. And then they never do it when it's just really good. It's only after it's gone mental that these things come crashing down. And we haven't had that crazy bubble yet in the NASDAQ, which is, really where all the stuff lives. So I think soon, maybe not weeks, maybe not months, but probably not many years, we will get that bubble in the NASDAQ. And it will be just like, 2000 all over again. And there'll just be mad companies. It won't just be half a dozen ridiculously overvalued companies. They'll be popping up all over the place. And there'll be, IPOs at 200 billion, 300 billion, 500 billion, a trillion. And everyone will be going, everything's marvelous. We're going to Mars with Elon. And that will be a bust, will then follow. So the thing to watch out for is that a crazy bubble begins, and anybody that likes to trade or, wants to, do that, run up that bubble and make a lot of money at that point, will be able to see it early. The other thing is, people will be able to see when that's happening that the end is near. And, bubbles are great because if you get them early, you make a lot of money. But the trick is getting out. You don't make money in a casino until you've left the casino. It's not a profit until you take it. And, it's no good having some, chip company that went from 1 to 50 if you ride it all the way back down to 2 again. So when that bubble begins, you'll be able to say, oh, here's that bubble that crazy English bloke said was going to come. And you can take advantage of it. And there'll be wonderful IPOs. And if you're in a position to pick them up, you'll be able to pick them up. And if you're in a good company that's, ridiculously expensive, it'll get doubly ridiculously expensive. It'll be a good time to, reap that harvest. But don't believe it's going to stay there and that bubble isn't going to burst. So what I'm saying is there will be a bubble. We haven't had a bubble. We've had a great boom. Haven't had a bubble. There will be a bubble. When it starts, you'll be able to take advantage of, oh, here's that bubble. But when it gets to a certain stage, it'll be time to leave. And, don't miss out on that. So even if you've got holdings and you see this bubble and it goes bubble, bubble, and everybody's singing Hosanna and there's all these crazy things happening and it's all marvelous, that'll be the time to consider de-risking what you've got. So like now in crypto, the Trump coin, now that is a klaxon signal that this is the top of this run. That is, a few people who've done very well in crypto over the last couple of cycles are exiting right now going, oh, here he is. If the Trump coin 200 multiplication that we saw in the last few days isn't the bit that's going to be the last chapter of the crypto bubble of 2025, I don't know what it's going to be. And it is a strong signal that the run that we've all enjoyed in crypto has come to an end. And I've been saying it for a few weeks now that this is probably pretty near the top in crypto and that we might see 120. But it's going to be very, very unlikely it's going to go much further. And if you got in at 20,000 and you're sitting on a 5x, what are you hanging on in there for? And I took my 5x and I'm now sat there prepared to cry as it doubles and triples and quadruples. But you have to, in all these situations on these crazy verticals, whether it's coffee, whether it's a stock, whether it's a crypto, you haven't made a profit until you've left the casino. And I think it's not a bad time to certainly find out where the exit is. So when you decide to head for the exit, you know where it is. Because it's, it is pretty toppy out there and it's behaving in exactly the way that the end of these runs happen. So back in the crypto previous run, it was the altcoins, so-called, the polygons, the matics that went, I bought it at 3, bailed at 32, and it went to 400. I missed that yacht. I didn't get that yacht, but I did all right. I got some nice houses out of it. But, that was the signal that the end of that run was arriving. Okay. And this time round, it was the AI meme coins that were doing that, 10x's and 20x's out of nowhere. And that seems to be all over that. And now we've got this clarion call from the Trump meme coin. And I would be very surprised if we are not in crash territory within 3-4 months.
And you mentioned the principle of selling early versus knowing when to sell. Warren Buffett is famously quoted as saying, when they asked him, how are you such a successful trader? He says, I always sold too early. I always sold too soon. And but now he's sold more. He's raised more cash for his company than any time in the history. And yet you say that the equity markets, in your view, are not yet in bubble territory. Several of our guests have suggested that the valuations that you could apply, no matter which way you look at them, could be described as bubbles. Perhaps it's just a different use of terminology, but what do you apply when you look at valuations?
It's a different multiplication. And, I think perhaps Mr. Buffett is feeling his mortality. And, if you were thinking that, Charlie Munger went this year, and do you really want to leave all those positions on for your antecedents? Or, when the people going to take over after you? Maybe maybe you think, well, maybe I need to de-risk this whole company because, there's only so many years at 90x that you're going to be around, and everything's, why not, go out at a high rather than leave this huge, complicated set of positions with all sorts of interesting things in them to a load of people that aren't necessarily the titans of finance. So, that's what I would think. When I saw that he was selling down, I thought, he's missing Charlie around, and he's thinking it's probably good practice to de-risk because, who's going to clear up after it? So that's what I think he's doing. I just think he's clearing up after himself, or making sure that everything's simple if anything were to happen. But so I don't take that as a sell signal.
You mentioned watching in the time of a bubble, watching for signs that it's time to exit. And you mentioned in the crypto space some particular egregious examples of something that seems irrational exuberance. In the case of the stock market, what about insider selling that's going on at a pace of 6-1 currently in the largest equities?
Well, yeah, insider selling is always a good signal that you're near the top of the market. And no one can say the American market is cheap in various areas, but there's still quite a lot of value, because what seems to be going on is a permutation of what you do if you're a hedge fund. Is you pick the darlings and you go long, and you pick the dogs and you go short. Okay. Now, if you take that, now you're market neutral, and it doesn't matter whether the market goes up or down, you're going to make money. That's the theory, and that's worked very, very well. But at a certain stage, you run out of shorts. So now you've got to spread your shorts amongst things that aren't so well correlated. And I think in the end, the logical conclusion is you get the Magnificent Seven and a lot of short positions all over the place in all sorts of areas to try to capture the short position. So the incredibly high valuations of the stars doesn't necessarily turn into incredibly high valuations of the second tier or the third tier. So if you look at someone like Intel, who are absolutely flat on their back, and I'm quite long Intel because, if you're going to have a trade war with China, when all your chips are coming out of Taiwan, you need to have fabricators, chip fabs, not in Taiwan, somewhere else. You've got to have them in America. You've got to have them in Europe. And you can't build them like that. It's not like a Elon Musk rocket being knocked out every 10 minutes. These things take years and billions to build. And the king of the fabs is Intel. These guys have got, they are the fab guys, effectively. And so you look at their stock and you go, wow, they're in comparison with the other guys, and NVIDIA, they might as well be free. It's pocket change for a lot of people in the top end of the market. So there is value out there. There is absolutely, without doubt, value in the American market. When you look at the nosebleed valuations of the NVIDIAs of this world, maybe what you're looking at is the sort of turbocharged hedge fund idea of backing the stars and shorting the dogs. And that has a systemic effect that is what would turn into the bubble. The other thing you've got to really grasp these days is these aren't efficient markets. These aren't free markets. These are highly curated markets. And the curation is coming out of government, central bankers, because their monetary policy is to print money to keep the money flowing, but to get people to stack it into illiquid assets. Because if you give poor people money, not only do they need to spend it, they want to spend it. They go down the supermarket and buy tomatoes, and the price of tomato goes to the roof. If you give money to rich people, they go, what am I going to do with this? I've got more money than I need. I'll give it to the bank. I'll buy real estate. I'll put it in stocks. So the real estate goes to the roof. Everybody likes that. It trickles down. People sell their house, whatever, feel rich. It's a trickle-down effect. Way uninflationary. That's why QE first time around didn't create inflation, because it went straight into illiquid assets or less liquid assets than cash. And equities is, buy and hold. Well, what happens to the money when you print it, give it to rich people, and they put it into Intel, or not into Intel, into NVIDIA? It doesn't go anywhere, does it? It gets stuck there. And it stays there, and then nobody's running down the supermarket to buy lettuce. it's got into a stock. It's in the financial system. It's into less liquidity instruments, which is how the central banks manipulate money supply. They push it up and down the liquidity curve. When they need liquidity, they pull it out of illiquid into liquid, and they can push it backwards and forwards using interest rates and QE and QT. And so what you are seeing in the markets is this liquidity made by the central bankers to keep the wheels on after COVID, and to fund the American government spending more money than it can borrow properly. You can't borrow it off the Chinese; they don't want it anymore. So the Fed uses its clever tricks, a way of recycling cash and printing cash and buying treasuries off the government. So there's all that going on, but it's going into illiquid or less liquid assets than cash, like equity, like real estate. And so you've got this relative increase in value, of real value in these assets, because that's a mechanism whereby liquidity is driven through the system these days. That is modern monetary policy at work. And that means that you can end up with what is not just a boom in equities, but a bubble, and it's been created by the increase of money supply and the increase and manipulation of liquidity. That makes sense.
It's an interesting way of describing it. I have not heard before about this illiquidity range and the money being pushed up and down that by the Fed. What about the risk that banks find themselves at holding toxic bond portfolios and toxic commercial loan portfolios? You've talked to us about, you believe the market is in a boom but not yet a bubble. What about the assets that are on the books of banks, perhaps in the U.S. starting, but in other countries as well, that you've looked at?
Well, the thing that people need to try to grasp is that money is media. It's media. It's a piece of paper with a picture on it. Okay? So run this thought experiment. There's this bank, and in the basement, they've got $1 billion in dollar bills. Okay? It's all in a nice, neat stack. Unfortunately, there's a spark from a piece of equipment, and it goes onto the dollar bills. Poof, they all burn. Now, the bank rings up the Fed and says, "Oh no, all our cash, it got burned. Oh, we've got to go bust now. Oh." Well, their money's burned, it's gone, right? So they're going to go bust now. But the Fed says, no, don't you worry. Just sweep up all the ashes, bring it to us, we'll weigh them, and we'll calculate how many dollars that was, and we'll print you some new ones, charge you for the paper. The bank goes, "Oh, we're not bust anymore. Oh, that's great. Life goes on." So what is reality and what is fantasy? When they had it there, was that $1 billion? Or was that a fantasy? Was it burnt? Was it gone? Or was it really still there? Or was it a fantasy? The point is, if you're a bank with a load of toxic money, but bonds, that money's gone. It got burnt. Someone else burnt it, or whatever, threw a party down the road, built a building. Yeah? But if the central banks step in and said, "Give us that, we'll QE that, give it to us, here's some treasury bonds, thank you very much." What happened? What's that going to do to the world? Nothing. What's not going to happen is the banks aren't going to go bust and take your money with them and crush all those companies that rely on them to process their payroll, et cetera, et cetera, et cetera, to collapse a load of companies that otherwise would have stayed in business making things and boosting the economy. So it's about the management of the system itself. Now, in the old days, if the system malfunctioned, it would set off a chain reaction that would create, systemic destruction. And people perfectly good, running perfectly good businesses, somebody running a cafe down the road, somebody running a bar, they'd go bust because the bank would go bust and all the money would be gone. They'd be ruined. Yeah. In the modern era, the central banker comes in and just says, "Don't worry about that so much. Oh dear, okay, we're going to do this and going to do that." And the person that sat there going, "Oh, these banks always bail out all these corporations," doesn't realize that he just got bailed out. He just didn't lose all his customers. He didn't just have to say, "Where's all the people that used to come to my bar and buy drinks? Where are they all gone?" Well, they were in that bank that went bust, and now you're going bust. So when money is media, It's not a piece of metal that had to be dug out of a mountainside. And it's all about managing that as a machine. Well, it's a different game altogether, and they've got quite good at it. But what happens when there's a new systems are built, there's what I call a hidden variable. Many hidden variables which don't count in the old system because they are plus zero squared, like a Black Scholes. But those hidden variables don't count. But the new system pumps all the risk into those hidden variables. And they're invisible and they're invisible and they grow and they grow and they grow and they grow. Oh, now you've got a CDO. Now you've got a derivative. Now you've got your Lehman Brothers going bust. When these new systems come around, they mutate until they cause a new problem. So if you look at all the crises in history, financial crises, it's normally linked to a new financial instrument. And that financial instrument will be what causes that problem. Right now, in my opinion, the way that liquidity is being generated without a doubt, is driven this boom in the market in America. But the hidden variable is that certain stocks are getting so highly valued, certain stocks are getting so highly valued that they risk becoming a systemic problem for everybody. So, if you go back to Japan, when they had their property boom, the value of the property of the emperor's palace was more than all the property in California. And then obviously it blew up. But the system of being able to borrow money for property was such that people could lever themselves up and lever themselves up and lever themselves up and buy more property to drive the price up, to buy more to borrow more money, to buy more property, to push the price up, to borrow more money, to buy more property, to push it. That is what they call a virtuous circle if you're long property. But it's actually a vicious circle because the system itself creates that never-ending spiral. And the only way, it can't keep going forever. It does have to blow up. And it blew up in the Japanese property situation. And markets blow up, whether it be tulip bulbs or be it the property system in the 2008 with all the derivatives. So they came up with all these property derivatives that drove the ability to finance property, to create property, to then market it from wholesale into retail. Because you've got the banks, they're basically wholesalers of mortgage debt and distributors of mortgage debt. And then you had people who were the retailers of mortgage debt and all these devices to take those borrowings and liquidate them back into cash, to lend it out again, to have more paper, to turn it back into cash, to lend it out again. Yeah. And so that was a virtuous circle that turned into a vicious circle. And they basically ran out of people to buy property. So that's why all these, zero money down, liar loan stuff came along, because that machine needed people to buy at retail, to buy those mortgages, to buy those houses that have been built off the borrowed money in that cycle. But of course, you run out of customers in the end. So you have to invent customers. And then the merry-go-round goes round and round and round until suddenly it breaks because it becomes a house of cards. And all financial systems go that way, particularly when you invent new instruments that give new powers and leverage to people in the finance industry. So go back to the crash of 29. That was leverage. That was being able to have margin. Margin caused that. Because everyone could go, oh, I can 10% down, I can buy a share, it goes up 10%, I double my money. I take my profit, I buy twice as many, I double my money. Yeah, that's going to work until suddenly it doesn't and it blows you up. And back in the tulip bulb days of the Dutch, it was options. They'd invented options. Here's an option on a tulip bulb. And that generated it. Initially, it was because the princes in the Ottoman Empire, back in the day, when the Sultan died, they'd line up the princes, and the oldest one would get to be Sultan, and they killed the other ones. That was kind of a pretty brutal thing to do, but that's what they did. And then they thought, this is a bit brutal, even for us. What we're going to do, we're going to lock them up in prisons. And they locked them up in prisons, and they all took up gardening. And they loved tulip bulbs, so the princes of the Ottoman Empire would send off to find tulip bulbs from all around the world. And they paid top dollar for that. And because there was these princes buying very rare, very expensive tulip bulbs, it generated a virtuous circle in tulip bulb prices. And then people started writing options on them. And that option market drove the tulip bulb prices nuts. And that's what caused that crash. And then they invented paper money. And then you got I can't remember which one was it. The South Sea bubble was paper money, John Law. And they invented paper money. And certain dukes went, I've got all this paper money. I'm going to run down the bank and take my gold. This is never going to work. And that cash flow, South Sea bubble was actually shares. The original equities caused the South Sea bubble. So all these new inventions of new financial instruments caused all these boom bubble bust cycles. And, they've invented a new way of managing liquidity and money these days. Because the old method was, we're in a recession, hand out money to poor people. And they rush down the shops and buy things, and the prices go through the roof, and you get inflation. The new method is hand out money to rich people, and they'll put it into property and stocks, and it won't cause inflation because it won't go straight down the supermarket for lettuce and stuff like that. So during COVID, when they handed out money to everybody, guess what you got? You got inflation because you handed it out to people that needed to spend it. Before, they were handing out to people that didn't need to spend it, and it trickled down. And now they're back to that model again. And the thing is, I think it will probably, in the next year or 2 or 3, drive that final part of the boom bubble bust cycle. And you'll see it in the NASDAQ. And then you can play that bubble, but make sure you're near the exit when the alarm goes off.
Can you bring us to, you've touched on sound money a couple of times in your discussion as you talk about these inventions of new instruments, including paper money. What about gold and silver in your view? Have any new wrappings been placed around those that are affecting their honest valuation? And what role do you see them playing in the economy of the future?
Well, first of all, what's the use case for gold and silver? The use case for gold, why do governments keep, warehouses full of gold? Do they like jewelry? Have they got dentists that they're going to need it? No. Are they going to sell it to the electronic industry? No. Why do governments need gold? They need gold for war. Gold is for war. That's why they keep it. And if you're a politician that believes that there shouldn't be wars, you sell your gold. And you're likely to be a socialist and you might even be English. Because you can't fight a war if you haven't got gold. How are you going to fight a war without any gold? When they say, yeah, you want the oil? Yeah, you're fighting a war. You might lose. Give us gold, please. Send us the gold. Oh, no, can I send you a bond? No, we don't want that. Send us the gold. Gold is for war. All right? That's the use case. And guess what? We're not going to, please, let's not have one. But global tension is increasing. And as global tension increases, if you're a government, you've got to buy gold. That's why the Chinese are buying gold. It's the Chinese government. Why are they buying gold? Do they want to give it down to people who want to build Rolexes? I don't think so. Do you think they want to, boost their dentistry industry? I don't think so. Yeah, gold is for war. And as global tension increases, the price of gold will go up in real terms. Now, if everybody decides to go to the UN and sing Kumbaya and all be friends, we're going to be friends now. Why don't we just cooperate? Why don't we be sensible? Well, gold will come down if that happens, but it's not going to happen, is it? I mean, everywhere you look, tension is increasing. So gold is going to go up. So you don't have to remonetize gold. I mean, people think, oh, in the old days, people had gold in their pockets and silver in their pockets, and it was real money. It was way more paper money. There's always been paper money. There was paper money in Britain in the Middle Ages. They were wooden sticks, and they would carve IOU into the wooden sticks and split them down the middle. Now it's called a tally stick. So it wasn't quite paper. It was actually a wooden stick. And they put them in the basement of the Houses of Parliament to keep track of it. So you could go back, I got my half stick. I want my money now. Right? And the sticks caught fire and burned the House of Parliament down. So there's always been paper money. I mean, if you were a duke in the 14th century and you were going to ride to Paris or something, you'd ride to Paris with a piece of paper. You go into a bank and say, this is my IOU from the bank in Milan, and they give you some money. It'd still be paper. There's always been paper. There's always been credit. the people didn't lend money to the king by giving them a big cask of gold. It would be credit. It's always been credit. There's always been credit. From the beginning of time, there's been credit. Gold was just a currency so that people could have it in their pocket. But, there was still plenty of paper money out there, plenty of bonds and plenty of IOUs. The whole point is I'm a guy, I got a bit of money and I've got it under my bed because it's the 15th century. So what am I going to do? Someone's going to rob me. So I go down to the goldsmith and say, could you take this gold, put it in your safe and give me an IOU, please? That's the beginning of paper money. And that's what the goldsmiths became the banks. That's why banks exist, because you don't want a big chunk of money in your house because they want to steal it. So you take it to the guy that is good at securing money. You give it to him. He might even charge you to keep it, or maybe he'll pay you to keep it. He gives you an IOU. That's money. So the idea that gold and silver are somehow has to be currency. It's the only currency that possible is actually not a thing. But they have use cases. Gold is for war. And the tension is not going to stop going up for years. I mean, when's it going to stop? When is it going to stop? It's going to go on and on and on and on. So gold is going to go up and up and up and up. Now, silver, that's poor man's gold. It has a use case. But, it's a B2C material. It's not a B2G, business to government or government to government. So gold is the one for increasing global tension. Silver will follow on, obviously. But, gold is the one that is going to be driving it all, because the world is, until they work out how to stop social media driving everybody mad. And, it's not just me and you who get driven mad and irritable and anxious by global media. It's all of them. Nobody more so than the politicians of this world. They're absolutely compelled by media, always have been. And social media drives them all mad. You can see them go mad on X in real time. Yeah. So that driving of everybody getting more and more stressed out, more and more anxious, and more mentally unstable, that's going to go on for years. And that's going to be in governments and geopolitics. And it's going to drive the price of gold. And, it's a one-way bet, gold, for the next 4 or 5 years, in my opinion.
You mentioned to me before we got started the gold-silver ratio and how it was driven by relative scarcity or supply of those metals in the past. What's your view of the current gold-silver ratio, and which way do you see that going in the future?
Well, if you dig a hole and you start, doing some chemistry with it, out pops silver. Silver's in pretty much every metal that you mine, lead, copper. I mean, although gold comes out of copper quite a lot, but silver basically comes out of all anything you do in minerals, you're going to get some silver there. So the amount of output of silver is really what causes its price differentiation with gold. And if you're interested in that sort of thing, the one that boggles my mind is platinum. It's 180 tons a year of platinum being made, 3,200 tons of gold. Platinum's $1,000 an ounce. Gold is, wherever it is today, 2,800 or whatever. So there's basically no platinum getting made. Yeah, and it's a very, very important metal going forward for things like all the green environment, because it's a catalyst for lots of chemical processes that are key to decarbonisation, whether you believe that's a thing or not. It was definitely a thing, but it's whether you believe it should be or not. But platinum is massively, and palladium is massively important in chemistry. And chemistry is going to be very, very important for the future, with all the strategic minerals and all the new technology and the hydrogen economy that may be coming along. And all that, and I believe it's going to be a big thing, hydrogen economy. And platinum's a big, hairy deal, batteries, etc., etc. And there you are, 180 tons a year coming out of the ground. And gold, 3,200 tons. See, if you look at gold, and people say, it's hard money and it's real money and there's no inflation with gold. Gold's inflating. Every year they're doing another 3,000 tons of it. It's about, depending on how much gold you think there is, because remember, gold gets lost, and gold isn't very liquid in as much as all the gold the governments hold, that's not going anywhere. Yeah, so the free flow of gold is a lot less than the overall flow of gold. Depending on how you calculate the production of gold, it's 2 or 3% a year of all available gold is newly mined every year. So you could say there's 2 or 3% inflation in gold. I.e., they print more gold. And, a lot of gold people go, they don't print gold. They don't print gold. You can't print. They do. They dig it out with spades. That's printing of gold. Then there is more of it. But I'm very bullish on gold, and the Swiss keep a fairly large amount of it for me. But the interesting one is platinum, because they make none, 180 tons, and you could probably put that in the boot of your car. So, but it's not a lot a year. 180 tons of platinum, and the reason it's so suppressed at the moment is because everyone's thinking that cars are going to go to be totally electrified. And all those cat converters, 30, 40 years of cat converters, well, won't be that much out there, but, a number of years worth of cat converters with platinum and palladium in them, that's all going to become platinum. And therefore, it doesn't matter they're only digging 180 tons out of the ground, because there's all these cat converters that can be melted down, or rather, cut off your car while you're not looking, ground into powder and shipped to China for reprocessing. Yeah? But that's going to end. And sometime in the next not many years, that's all going to end, because it's all going to be electric cars, maybe. But, the cat converters to platinum is either going to go back the other way or stop. And then there'll still only be 180 tons coming out of the ground. So that is a very interesting long-term stack. And I know your viewers are often stackers. I'm stacking platinum. I can't, as long as I live long enough, I can't see that that's anything but a one-way bet, because they just don't make it platinum. It's just like, how many tons a year? You're kidding me. That's like none. So, gold, silver, platinum, palladium, why wouldn't you stack that as part of a diversified portfolio?
Clem, you mentioned in the beginning that you're starting a new financial network, anewfn.com. What's going to be there, and why are you doing that, and how will people be able to take advantage of it?
Well, a long time ago, I started a company called ADVFN, which is a fantastic financial site. And I've been away from that for a few years. And, once you get away from being in the trenches with these sort of things, you kind of start getting ideas. And it occurred to me that when you look at a lot of the internet these days, it's very old. It's very, very old. It's very 2000. And, me and the team have come up with some very interesting ideas of taking it into into this decade rather than 3 decades ago. Because, there's a lot of new ideas, and you just don't see them on the internet. You really don't see much fresh stuff on the internet. Even something amazing as ChatGPT, it's a load of black and white text. And I did, back in the 90s, I did some work and ended up getting picked up by NASA, actually, for data visualization. And I did a whole load of articles for Wired magazine, looking at financial information in multiple dimensions, like, 6 or 7 dimensional images. And people say, can't have 6 dimensions, but you can. And that was, I made a reasonable amount of money using those tools to see things that other people can't. Because at the end of the day, people say, well, the market is random or it's not random. But it depends on the lens that you look through. And if you build lenses for information, lenses that take away the noise, take away the disability not to get to what you want to see immediately, then you can see opportunities that other people don't see. And so that's something I've got a long background on. And people who are listening to this will say, yeah, it's saying all these things I don't understand. What the hell's it talking about? It's because, I've over the years used a lot of tools that see things differently. I was saying earlier about Intel. Now, people aren't thinking about, well, what happens when TSMC in Taiwan has a little bit of a problem? How are they going to make chips then? And people are thinking that if you were NVIDIA, who's going to make your chips? If you're Apple, who's going to make your chips? If you're Mr. Trump, what are you going to do about your chips if you're going to have a fight with China? Or if you're going to start shouting at them even more? Who's going to be making your chips for you? So, the answer is, that's how you've got to be thinking. You've got to be trying to think ahead, having ideas that other people haven't had. And For that, you need information. And for that, you need a supply. So you can get a lot of information very, very quickly that throws up things that you go, well, what's that there? What? Only 180 tons of platinum? I mean, that's the example. I mean, when have you heard anybody say that? 180 tons, it's almost unbelievable. In fact, amusingly, every sort of 4 or 5 months, I go check that number up because I can't believe it. I go, yeah, there's only 180 tons of platinum being made. I can't have got that right. It must be 1,800 tons. So I've got to look that up again. And there it is. And I go, wow, that's unbelievable. So picking up data points like that is how you make the money. Getting there early, not late. Not being the last person to buy, but the first.
So how will people find you? Do you need to go to anewfn.com?
Well, if people go to anewfn.com, they can get on the guest list because we'll be opening, not for business, because we'll be opening as a site, as a destination. And I'm sure Google will be there giving us advertising to show your lovely viewers. But there's a guest list for people that want to get and see it early before anybody else. And people can just go to that page and put the name down for that. And we're modern. We're youngsters. We do drops. We're going to do drops, and it's all about getting an early community, getting what they want. Because I know what I want, but it's not necessarily what other people want. And finding out what they want and giving it to them in a way which is excellent and timely and accurate. And so much stuff out there is inaccurate and untimely and wrong. And being a good site to go to where you get to have the stuff on the button and it's well done and it's quick and it's accurate, that's actually quite rare, and there's an opportunity there. I mean, I used to run the Investors Hub, which is a big US small cap private investor site, still pretty popular, I understand, and in ADVFN in Europe, which is again still very popular and a big site. And so it's going back to my roots.
We've been speaking with Clem Chambers, the founder of a new financial network at anewfn.com. Clem, thank you for joining us again on Liberty and Finance.
That's my pleasure. And by the way, if you want to follow me on Twitter, occasionally, I don't say much, but when I do, it's normally worth getting.
Very well. Thank you, Clem, for joining us.
See you soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 13th through January 20th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.